Hello there. Hi, welcome back everybody. Ed Ponsi here. On behalf of FX Street, welcome back. It's Thursday, April 20th, 2017, first of two sessions. Hope everybody's having a wonderful day wherever you are. Let's get started. If you have any questions, don't hesitate to type them in if you're attending live. And hello to everybody who's listening to the recording. We know lots of folks listen to the recordings as well, so it's good to see everybody out there. Let's get started. Yesterday we entered, or I should say earlier this week, we entered on Aussie yen on the 10-day exponential moving average. So I'm going to put that 10-day exponential moving average up there. Start with this. And you can see it, and that's your entry point, is when the price hits that 10-day. You can see it comes up above the 10-day. So the entry point is the 10-day itself, which was 82.81. It came a little bit above there, came up just above 83, but it doesn't hit the stop. The stop is 83.24. Just to review, how did we get that stop? The stop is half of the ATR. The ATR at that time was 86, meaning that Australian dollar Japanese yen currency pair was moving at 86 pips per day at that point. Half of 86 is 43. The stop is 43 pips. The price comes through the moving average, but doesn't come through by 43 pips. It comes through by about 15 pips, misses the stop by about 30 pips, and drops. Subsequently dropping to about 81.40. So that we were up by about 95 pips on this trade. Subsequently, we were up by about 100. The trade, it's 80 pips on the trade right now. Now, at any point, you can close half of the trade. So when you were up 90, when you were up 140, when you were up 80 right now, you could close half. And that's at your own discretion. And the reason why I leave that in there is sort of a safety valve. Because I know what happens. From my own experience and from doing this for many years is that people can't handle being in a situation where things are going that well. And what they do is they say, oh my gosh, I can't believe I'm up by this much, and they close the trade. And what happens is they close the trade, they're up because they're not used to being up by that much. And they close the trade when they're up 60, and then they realize later that they could have been up 600. Why? Because they've never been up 600. They've never been up 60 before. They don't know what it's like. There's only one way to find out what that's like, right? And you're never going to find out what that's like if you don't leave one open, right? So what I'm saying is, if you wanted to close half of the trade at some point, that's fine, but we're going to mechanically continue the trade with the second half. And that's what we're going to do right now. So when we left off yesterday, we said when a new candle forms and an old candle closes, that's when the stop is moved. So this was the open candle yesterday. When this candle closed, that's when it was time to recalculate the stop. So let's do that recalculation now, because the stop should no longer be up here. Now, anytime you're in a long position, we can only bring the stop down. We can never bring it up. We can either bring it down or we can leave it where it is. So let's do the calculation. I'll walk you through it. And we'll see where that stop should be located right now. So we need the ATR, that's average true range, and we use the daily ATR, 14 time periods. By the way, 14 time periods is your indication that this indicator was created by Wells Wilder. Whenever you see 14 as the default indicator, the default setting, that usually means it was created by J. Wells Wilder Jr. Right, so he created RSI, ATR, and a variety of other indicators. So today's the 20th. This candle's open. So you always go to the most recently closed candle. We'll recalculate this again, assuming that the trade is still open. We'll recalculate this again when this candle closes. But right now, the focus is on this red candle, yesterday's candle. I need two pieces of information in order to do this. I need the moving average as of yesterday's close, and I need the ATR as of yesterday's close. So if I left click on this candle, I'll get that information. Now, when I left click and I hold it down, at the very bottom here, you see AVG EXP, that's average exponential, 82.58. So that's the moving average. The moving average is different from yesterday. Yesterday's moving average, I'll put it on yesterday's candle. Yesterday's moving average was 82.809, which is 82.81. That 80 and 9/10 averages to 82.81, which also happens to be yesterday's entry point, right? So yesterday, the moving average was 82.81. Today, that moving average has moved down. It says 82.589. So call it 82.59 is the moving average. Okay, so we know the moving average is 82.59. I'll put that in blue. 82.59. We'll put that in blue to match the moving average, right? So that was yesterday's moving average, 82.59. Now, the stop does not go right on the moving average. The stop goes above the moving average. Why? Well, do you see how the price is on one side of the moving average? That's why the stop goes above the moving average. We're hoping that the price will stay under the moving average, and we'll keep our stop on the other side of the moving average and trail that stop down. And we're hoping that the price just stays below the moving average, and the moving average will keep moving lower, and we'll keep our stop above the moving average, and we'll keep pulling that stop down. So as of yesterday, the other piece of information we need is the ATR. What was the ATR as of yesterday? We see the number right here, 0.8296. Now the way that you would read that is 83 pips. But that's not correct as of yesterday. That's correct as of today. As of today, Aussie Yen has an ATR of 83 pips. But we need it as of yesterday. So if I click, and this by the way, this represents the ATR, this line. So you can tell it probably was a little bit higher yesterday, right? Because you see that line descending. So if it's 83 right now, it's probably 84 yesterday. Just taking a guess here. I click on it. Can you see the letters ATR? 0.8493 I would round that to 85, actually. 85 pips. What's half of 85? Well, get out your calculators, or if you're lazy like me, you can just ask Siri. Hey Siri, what's half of 85?
It's 42.5.
There you go. It's 42.5. So round it up to 43. So 43 pips. Your stop is going to go 43 pips above the moving average. The moving average is 82.59, and your stop goes 43 pips above the moving average. Why? Because your stop, that goes 43 pips, is half of the ATR. Excuse me for 1 second. Okay, so we got that. Half of the ATR above the stop. So how do I know where the stop goes exactly? It's simple. Now I just add 43 pips to this moving average. Very simple, right? So 82.59 plus 0.43. Another way to do that, just a little way to cheat if you want, is with your calculator, is just simply don't use the decimals, right? For example, all right, we'll use Siri again. Watch this. Siri, what's 8,259 plus 43?
The answer is 8,302.
Okay, 8,302. Or 83.02 would be how we would write that in Forex language. That's our new stop. 8302 is our new stop. So the moving average is 82.59 plus 43 pips means I can bring the stop down to 8302. Is that acceptable? The answer is yes, because I'm reducing risk. Was about 43 pips yesterday, right? If my stop was hit yesterday, I would have lost 43 pips. That's the distance from the entry to the stop. If my stop gets hit now, the risk is about 21 pips. I've basically just cut my risk in half without reducing my potential profit. What is my potential profit? Well, there is no target. As I said, you can close half of the trade anytime you want. The other half of the trade, we will eventually get stopped out. But what we're hoping is that we can continually lower this stop until we're stopped out with a profit, hopefully a large profit. That does happen once in a while. But it doesn't need to happen very often to make a big difference. And that's really the key to this strategy. It doesn't need to happen all the time in order to make a big difference. And that's why that's what makes it special. So the stop, I can remove this now. The stop has moved to 8302, and maybe we'll get stopped out today. And if we do, Well, you've already probably closed half the trade with a profit of 100 or so. And then you'll get stopped out on the other half with a loss of 21, which means you win. It's a nice win. Pretty good. Or maybe you won't get stopped out and this thing will continue to drop and run. And we'll get to continue lowering the stop, which is what we hope will occur. And hopefully we get to continue lowering the stop. And that's just it. Now, we don't know what's going to happen next. And that's okay. You don't have to know what's going to happen next in order to make money. Maybe we'll get stopped out today. Or maybe we'll get stopped out a month from now with a 1,000 pip gain. We don't know what's going to happen next. But you don't have to know what's going to happen next in order to make money. These are 2 of the 5 fundamental truths. Have I explained the 5 fundamental truths to you? Perhaps not. Now's as good a time as any. 5 fundamental truths come from Mark Douglas. You don't even need to know all 5. If you just understand the first 2 and the last one, then you're good to go. First one, anything can happen. Once you realize that anything can happen, you stop trying to predict the future, and that's good. Because predicting the future is a waste of time. A lot of us believe that trading is prediction, but trading is actually that trading is prediction because it seems like it's prediction, but it's not. And then you turn on television and you see 17 hours of prediction every day. But in reality, it's prediction. Just like gambling, to 99% of the population, gambling is prediction. But to that same dozen or so people who always seem to finish at the very top at the World Series of Poker every year, it's not prediction, it's reaction. Number 2 is you don't need to know what's going to happen next in order to make money. Well, that's a good thing because you don't know what's going to happen next, right? See number 1, anything can happen. But you don't need to know what's going to happen in order to make money. And that's a good thing. If you just understand those 2, that can change your outlook on trading. Change it from prediction to reaction. Another one, and the 5th one, I'm just going to jump to number 5. Every moment is unique. Every moment in the market is unique, and therefore, prediction is futile. Right? Patterns do reoccur, but at the same time, we are very often trying to find order from chaos. And the mind is always trying to create order from chaos. And there's a certain degree of randomness that can never be fully accounted for. Okay, so I always try to encourage people to look into these 5 fundamental truths. You don't even have to know all 5 of them. If you just know 1, 2, and 5, I think you're ahead of the game. Abdul with a great question, referring back or apropos of our trade, which means referring back to our trade. Proper use of the word apropos. At some point, can the stop be below the moving average if the price drops quite a bit? No, it can't. The price will always be above the moving average. However, the moving average can drop quite a bit. I'll give you an example. The stop can never drop below the moving average, but the moving average can drop tremendously. And that happened in dollar Canada back here. Let me take you back a while ago, and this was with the 20, not the 10. So I do this sometimes. This can be done with the 10 moving average exponential or the 20 moving average exponential. In this case, it was the 20, right? I'm going to take these lines out as they don't really serve our purpose back here. So we're going back to about a year ago, and you can see the price hits the 20 and drops, hits the 20 and drops, hits the 20 and drops, and this goes on for months. When it starts, dollar Canada's at 140. By the time it ends, it's 1,500 pips lower. And it went on for about 4 months. So the stop always remained above the moving average, but the moving average dropped 1,400 pips. The stop out finally occurs here, but the stop never dropped below the moving average because the stop was always above the moving average by half of the ATR. So the stop moved down by over 1,000 pips, but it never got below the moving average. Good question. Very good question. And I definitely encourage you to continue asking questions if you have them. But this was an example of one that, fairly recently that really took off. And there was one on, I think it was Aussie yen, on the bullish side late last year. It may have been on the 10. Of course, this sort of messed things up, but you can see there was a lot of activity here on the 20. This was the election. You can see the election sort of ruined that one. And then after the election, that was the U.S. presidential election, I should say. After the election, look, 10, the 10, the 10, the 10, the 10. And it really, look at it go. 100, 200, 300, 400 pips, and it just keeps going, and then it finally breaks here and stops out. Right? That's an incredible run. And in a fairly short amount of time, too. It's just hundreds of pips in about a month. But at no point did the stop come above that moving average. The stop out occurs when the price breaks through that moving average. And that's fairly recent. That stop out occurs in December. So, these are how people are able to get, gains of hundreds of pips on one trade. And it's very simple. All they have to do is move the stop once a day. Provided that you're not stopped out, you just have to move the stop once a day. And that's pretty simple, right? It's pretty simple stuff. So I wrote about this in 10 years ago. My book, Forex Patterns and Probabilities, came out. There's a chapter in that book called the FXEd Trend Technique. So I wrote about it extensively in that book if you ever wanted to read up on it. I've seen it applied. I've gotten emails from people who've applied this to futures trading, trading the S&P 500 futures, trading all kinds of different instruments using this technique. Stocks, right? Futures, and of course, Forex, which is, and why did I design this? I designed it because I was always getting out too soon. And then you kick yourself as you see that, you've made 30 pips and you should have made 300. I had to create a way to force myself to stay in the trade. When and how do you add to the position in this method? That's a great question. Okay, let's say that you're moving the stop up, right? At some point, if you keep moving that stop up, you're going to move it above your entry point, right? Now, even like on the trade right now, we still have a potential loss. But let's say if I'm able to continue moving that stop down, at some point my stop will be under the entry point, right? Which means there's no risk. So I'm allowed to risk 2% of the account per trade, correct? But if my stop is under my entry point, I'm not risking anything. So let's say my stop is under the entry point and then the price comes up and hits the moving average. If that happens, well, that's how I got into the trade in the first place, right? I got into the trade in the first place when this price came up and hit the moving average. So it comes up and hits the moving average again, and I'm risking none of the account. I can go ahead and do another entry. So I can add to the position in that way. Sound good? So it's optional. You don't have to add to the entry. But you would add to the entry if and when the price comes up to that moving average, assuming that you no longer have any risk on that trade. It's optional. Pretty neat, huh? I really enjoy this. If I could only do one type of trade, this would be it. All right, this is because it's very low maintenance. There's very little that needs to be done. It takes 15 seconds to move the stop, and then you're done for the day. The only thing is, sometimes you get very, very few opportunities. You might go through a long period of time where nothing is trending, and then suddenly everything starts trending. And then you have more opportunities than you know what to do with. So that's the one downside. So, obviously, it's a good thing that we're not stuck with one technique. So as of right now, we still have risk on this trade, but I was risking 2% of the account. Now I'm risking 1% of the account because we've lowered the stop. Hopefully we won't get stopped out, and we'll get to, bring that stop down to break even and beyond. And when we can lower the stop beyond break even, maybe we'll get to say, well, if I get stopped out, it'll be with a profit. And of course, that's the position that we want to be in. That if we get stopped out, it'll be with a profit. Okay. I believe that's going to end this session. But there's so much more to talk about. Some economic numbers just came out. There's a setup potentially happening, setting up right now on British pound that we haven't had time to get to. So let's come back in 30 minutes and we'll meet up again, and there's so much more to discuss. So until then, this is Ed Ponsi on behalf of FX Street. Thank you so much for listening. I'll meet you back here in 30 minutes, okay? Thanks again for listening. Take care.